Okay, Professor Jim Schultz here from my Finance 512 class. It is Tuesday, July 14th, and I wanted to go ahead and dive into the Thinkorswim software because we are now kind of at the beginning of earnings season. For the next couple of weeks, this is when most of the companies in the S&P 500 are going to be reporting their earnings from the previous quarter. And so one of the things you guys have to do in my class is you're going to have to listen to some of these earnings calls for a couple of your smaller projects. But I also want you guys to set up some options positions around these earnings calls. And I'm going to kind of show you, there's a million ways you could do it. I'm going to show you one way that you could do it looking at Bank of America today, because they have earnings coming up tomorrow morning before the bell. And also I would like to point out, as you guys can probably see, I am taking it on the chin today. And so, hey, that's what happens, when the market refuses to go down and you are short. And so you just got to take your medicine and you just got to hope for brighter days. And so let's take a look at Bank of America, and I'm going to show you, I've already got it loaded up here in the software. I'm going to show you some really cool things about the software. The first thing I want to show you is, if you guys remember, if I get rid of these August options, if you guys remember, I showed you, when you look at the option statistics, I showed you how to find the implied volatility. And then when you have the implied volatility, you can then, whatever option you're looking at, you have your days to expiration, you take the current price, and you can measure the expected move for the stock. Well, here's what's really cool. When a company has an upcoming earnings call, like the day before that earnings call, and so since Bank of America is reporting in the morning before the bell goes off, this is the last time you could trade Bank of America before they report earnings. Well, one of the things you guys are going to recognize from watching these earnings calls is these are typically referred to as binary events in the marketplace. They're binary in nature because these numbers are so widely followed by investors everywhere that oftentimes you will see the stock either shoot way up or shoot way down as a result of their earnings call. And so that is why these events are very binary in nature. And so I want you guys to have some experience putting trades on around these earnings calls. So what I'm going to do is I'm going to use the July option that only has 3 days left that expires this Friday. And here's the reason why. When I do an earnings trade, and this is what I would recommend you guys do as well, when I do an earnings trade, it is an overnight trade. It is a one-day thing. I'm not looking to hold this thing any longer than I absolutely have to. I'm going to put the trade on today, and then I'm going to let them report their results in the morning, and then when the market opens tomorrow, as soon as I can get to my computer, I'll go ahead and take this thing off. For a gain, for a loss, for break even, whatever it is, I'm going to take it off because it is a one-day type thing. Normally, I would wait till the end of the day to put my trade on, but I wanted to get this video done for you guys before class because we're going to talk about this in class tonight, and so I want you guys to have this for your own reference for the rest of the earnings calls coming out the next couple of weeks. So let's pull up these July options. Okay, so here's what I'm going to look at. So let's see. Well, I'm questioning whether I want to use July or not. And so, yeah, I'll go ahead and use July. That's fine. It's fine. And so the reason why, well, I'll explain why. I'll actually walk you through why I paused right there. Okay, but here's the first thing that I want you guys to recognize. Up in the upper right-hand corner, there's this MMM number. That stands for Market Maker Move. And here's what this number means. Thinkorswim has already went ahead and calculated what the overnight expected move is anticipated to be for this stock as a result of this earnings call. And so the expected move in Bank of America as a result of this earnings call is 41.5 cents. And so, again, it's plus or minus. We don't know which way it's going to go. But it's essentially 41.5 cents. And so what I want to do is I want to put on either a strangle or a straddle, basically surrounding that expected move. Because what I'm betting on essentially is that Bank of America is going to stay inside of that expected move. It's not going to go past that expected move. Now, you know, that's not the only thing that you could do, right? Like if you feel really good about a stock and you think, hey, I'm pretty bullish on this stock going into earnings, then you could sell a put spread. That would be fine. There'd be nothing wrong with that whatsoever. Or maybe you're bearish on a stock. Maybe you feel like, hey, they're going to miss their numbers and they're going to go down after this earnings call. Then you could sell an out-of-the-money call spread. That would also be fine. There's a million different things you could do. You could sell a naked call or you could sell a naked put. You can do all these different things. And so I'm only going to show you guys one possible example. So what I'm looking at doing here is I'm looking at doing the 17 straddle. So if you remember, we talked about strangles a little bit in class. It's where you sell an out-of-the-money put and you sell an out-of-the-money call. But the problem is this. With the stock price at 17, if you look, if I sell the first out-of-the-money put, it's 16.5. So I sell that guy and then I sell the 17.5 call. I'm only picking up 14 cents. That is not really enough juice for me, because again, that's the most I can make, right? And I'm taking unlimited risk, and so I don't really like that risk return trade-off. I need a little bit more meat. So what I'm gonna do is, a strangle is an out-of-the-money put and an out-of-the-money call. A straddle is where you sell the same strike. So I'm gonna sell the 17 put and I'm gonna sell the 17 call. Now that's 46 cents. That's a little bit better. That's a lot better than that strangle was. And so that's essentially going to put my break evens. I'm going to have two break evens. I'm going to have, if we do the confirm and send, my break evens are going to be, let me move this box out of the way. I'm selling the 17 strike, right? So I'm going to have an upside break even and a downside break even. The upside break even is going to be 17 plus the credit I receive, which is 17.46. The downside break even is going to be 17 minus the credit I receive, which is 16.54. Now, Bank of America is not exactly pinned at 17. It's at 17.14. And so I've got a little bit more room to the downside than I do to the upside. And I'm neutral to bearish on Bank of America tomorrow. So actually, I don't mind this. This isn't too bad. I'm going to go ahead and put this trade on. But let me get out of here really quick because I'm going to show you guys. This is why I was hesitating in terms of whether or not I wanted to do July or maybe August. Sometimes I would do the weeklies too, but I'm not going to mess with the weeklies for the purposes of this video. So I got, 46 cents for this straddle in July. If we go out to August, you're going to get a lot more, right? Why? Because there's a lot more time. And remember, with more time, it gives the long side more time to be correct. So you as the short get to charge more for taking the other side of that contract. And so that's 96 cents. And so some of you might be thinking, well, why wouldn't I just do this one? Well, it's because with so much time left, I like the July option because it's so close to expiration. If I'm right, I'm going to get paid off a lot more quickly than if I'm right with the August option. If you're right with the August option, there's still so much time left that those options are going to hang on to a lot of their value. Where being on the short side, remember, how do you make money if you sell an option? You make money if the premium collapses, right? You make money if those premiums deflate and come down to zero very quickly. The problem with these August options is even if I'm right, and let's say Bank of America reports tomorrow and they go down a little bit, but they stay right around 17. These options are not going to lose a whole lot of value because there's still 38 days left until expiration in August. So I'm going to go back to July. I'm going to do the July options for all the reasons that I just mentioned. And so I'm going to sell the 17 put. I'm going to sell the 17 call. And I'm going to do, yeah, I'll go ahead and do a 10 lot for the purposes of this, this virtual account. That's fine. So confirm and send. Max profit is $450. Max loss is infinite. And so I would like to go ahead and get filled on this. Bank of America is not an amazing go. We're filled. Beautiful. So we're in at 45 cents. And, obviously my hope is this goes a little bit better than some of the other things I have on. But that's it. One example of one of the things you can do around earnings. I want you guys to do at least one of these before the semester is over. And so you could do a strangle, you could do a straddle, you could do a put spread, you could do a call spread, you could do a naked put, you could do a naked call. Hey, you could research other strategies and go ahead and do some other strategies. I have no problem with that whatsoever. Those are just some of the ones that we talked about in class. So I hope this video was helpful for you guys, and I'll see you next time.